Hey, Steve Saretsky here. As always, the Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. Quick little bit of housekeeping. The Saretsky Report for February 2019 is now available. There's going to be a link to that below. It's basically a comprehensive analysis of my thoughts on the Vancouver housing market, in-depth review, so you can subscribe to that. Totally free. I highly encourage you to check it out. I'm going to do a little bit of a deep dive on the February numbers here in Vancouver, a little bit from the Bank of Canada, a little bit of macro perspective as always. But first and foremost, we saw the Bank of Canada this past week take a huge dovish pivot. Really should come as no surprise. It just baffles me to see bank economists, again, reading their tweets, reading their economic letters getting sent to me, how caught off guard they are by the Bank of Canada's dovish pivot. Again, all you had to do was look at global central banks are all turning dovish at the same time. It's a pivot towards easing, as global growth, the narrative of global growth is clearly delusional. They've switched gears now. I mean, the Canadian economy in December, it's now contracted 3 of the past 4 months. The housing market continues to slow from a national perspective. Credit growth has dried up. It really, again, should be no surprise the Bank of Canada has turned dovish. And I've been saying this in my videos for the past 3 or 4 months, that the last rate hike the Bank of Canada would get away with was in September. And that's appearing more and more likely to be the situation. And again, what we're now seeing is you're seeing the Canada 5-year bond. Those bond yields are plunging right now. And again, they're plunging for the wrong reasons. People are getting ultimately all excited and saying, I think this, yeah, sure, it could definitely provide a little bit of juice to the housing market, at least to get some easing up on rising interest rates, rising borrowing costs, most definitely. But the only reason why the bond yields are falling is because the market is sniffing out that Canadian growth is in the dumps, inflation pressures have subsided, and you're teetering ever closer to a recession, which is ultimately, of course, not good for markets. So that's the reason why the yields are falling. And why the Bank of Canada has turned dovish. They're not turning dovish because growth is great and that's a positive outlook. They're turning dovish because the data is sour, and growth is slowing significantly, and that is primarily being led through the housing market. So, as I said on national TV, you can go back and go watch my interview 2 months ago on CBC. I said that Vancouver housing, despite consensus that Vancouver affordability would get worse in 2019, I was on camera saying that Vancouver affordability would get better. The argument they were making was that rates were going to continue to rise and that would offset any decline in home prices. And as I said, what you'll see is the home prices are going to come down, as we're seeing, but yields, I said, I suspect that yields will actually fall. You cannot keep raising interest rates on the amount of consumer debt that we have on the economy, and it was clearly going to slow if housing continued to roll over. So housing affordability will get better in Vancouver, and that's clearly what we're seeing in the numbers. Let's go through some of the February 2019 data. It was the worst February on record for Greater Vancouver home sales since February 1985. This is data directly from the Canadian Real Estate Association. You can't make this up. This is strictly a data point. Now, you can not like it, you can disagree with it, but this is strictly from a data perspective. Now, of course, as I've always said, if this data starts to change, if the numbers start to get better, I will happily report that and let you know, because this is not about being right or being wrong. This is simply about providing value and ultimately my thoughts on the market. But the thoughts on the market, I think, need to be data dependent. So if we look at the sales volumes, the lowest since 1985. I never thought I'd have to go back. Even myself, I never could have pictured sales volumes were dropped in 1985, considering the fact that the population growth since 1985 is, I would have to double check the numbers, but I think it's close to doubled since then. So it just kind of goes to show you at least on a per person basis, the volumes have dried up significantly. So I think with that in mind, I almost think that there has to be some sort of potential pivot from policymakers here, maybe not just on the stress test, but at least on the 30-year amortizations. I don't think that's going to be enough to offset 30-year lows in home sales, but I think that you almost have to sort of counteract that, because that can be a slippery slope. If you let credit completely dry up like that is going to have significant knock-on effects on the economy. So I think policymakers should almost be trying to counterbalance the significant decline not only in household credit growth but in national home sales. As we're seeing the volumes dry up, right, that creates that liquidity squeeze that increases the inventory, which we were seeing significantly, and that eventually pushes on prices. But the prices become very sticky because home sellers are emotional to their homes. They're emotional to the price they want, and so they reluctantly reduce prices over time. And that's why real estate corrections can be very long and drawn out. But of course, we in Canada, we have not seen that since basically the 1980s. So this is truly unprecedented times that we're in. Unfortunately, there's short memories. Not many people want to go back and actually read history books. But comparing today's market to 2008, well, guess what? 2008 lasted 6 months in Canada, in Vancouver. That market correction lasted 6 months. So if you weathered a 6-month storm, you were laughing. But here we are. If you owned a detached home, you've been in a bear market for about 2 years now. So this is clearly, I think we need to understand where we are today. You can see the MLS benchmark, as I've said before, is a lagging indicator. The detached home prices are now down 10% year over year. That's what they're reporting anyways. As I've said before, it's more than that, but the official metric is showing 10%. You have condos now showing that they are down 4% year over year. The condo prices are down 4% year over year. I've said confidently that I think that number today, realistically from peak price, condos are down about 10 to 12% off their peak valuations. But the MLS benchmark today shows 4%. But I suspect, again, how that's reported, that number will continue to steepen in the months ahead. So, and that's really, again, just like basically a lagging indicator. So, as I always say, these are just the numbers today. I certainly encourage people to disagree with the points of view. I think two views make a market. I am, again, not the be-all end-all. I'm not trying to forecast the market here. I'm simply reporting the data and my thoughts and what I'm seeing in the market. I would add, because I know that there's going to be a lot of doomsday people on here, that obviously sales falling to the lowest since 1985. I would add that I really don't see any sort of panic in the market. I don't see people flooding the market with new listings. I think that if you actually not aggressively, but I think if you adequately price an affordable unit, so like an affordable one bedroom, it will actually move. It will sell. You won't get that peak price. Like I said, you're still off about 10 or 12%, but it'll move. There's some liquidity there if you can actually price it aggressively. There's some demand there, no doubt about it. Same thing for an entry-level single-family house. If you adequately price it and it has like a mortgage helper basement suite, there's definitely some demand there. Like let's call it what it is. The sky is not falling. Banks are still lending money. Yes, they're tightening and they'll continue to tighten. But it's not like the U.S. where the banks are seizing up. You can't get a loan. This and that. So it is a much different scenario. But again, I am concerned, obviously, that sales volumes have dried up as much as they have. So it'll be interesting to see how policymakers begin to react to this. But you can start to see, we've seen the ripple effects in the Canadian economy. You're seeing things slow down. You're seeing that, again, I've said that the key metric to watch, I think, or the interesting story that will develop this year is how the pre-sale construction market starts to play out. As I mentioned, the Pre-sale absorption rate continues to slow, i.e. developers are having to increase the incentives and lower their prices to get pre-sale people to lock into prices. And so you saw the pre-sale absorption for released units in February fell to 15%. That's off its peak, which was set in January 2018 at 94%. So the pre-sale absorption rate has slipped to 15%. I mean, it's a significant decline. And you're seeing the number of unabsorbed units that have been released and basically not sold. The unabsorbed units have grown exponentially. And so what this is ultimately going to do, as we know, the old simple supply and demand, is that this is going to push down on prices. Developers are going to have to lower their prices, or if they don't have the ability to lower their prices, the project will not be getting off the ground, period. So, as I said, I think in 2019, you'll see housing starts drop like a rock. And that is typical of a real estate cycle. This should not come as a surprise. Everybody's calling it, the end. Oh my gosh, like, see what the government's done. Oh my gosh, they've killed housing starts, da-da-da-da-da. I get it, but this was inevitable. Whether the government just went completely hands off, eventually the cycles tire themselves out. It's typical of a real estate cycle to see an overbuilding at the end of the cycle. Prices drop, builders pull off, they have trouble getting financing, housing starts drop. This takes time to work its way through the system, and as a result of that, you then create shortages down the road, and that's how prices begin to rebound over time. So again, that's what you'll eventually see in Vancouver, but as it is today, you have a lot of more supply coming down the pipe that will put pressure on prices here moving forward, and that's just the way that cycles work. So nothing to be calling the end of the world and doomsday on. As I said, we'll continue to monitor and be data specific here. Continue to be fascinated and curious to see how policymakers will react to obviously data that I think they're underestimating really how slow things have gotten. We saw Toronto. I don't talk much about Toronto, but for all you people from Toronto, we saw Toronto home sales, or Greater Toronto home sales for February, unadjusted sales, had the worst February in 10 years. You can go look at Calgary detached properties to start the year for the first 2 months, January, February. They've had the worst sales volume since I believe it was 1982 or 1983. So this is just, again, this is a national slowdown, and that is primarily from an extended Canadian credit cycles where it's just the reality of the situation that you can't continue on a credit cycle forever. Households can't borrow to infinity. Unfortunately, they're not like the government where you can just keep issuing new bonds. Households don't have the ability to finance their debt through issuing bonds. So they don't have the ability to roll existing debt other than through refinancing their home, which is, again, coming to an end because home prices are not rising. So anyways, that's all I got for this week. Hope that helped. Otherwise, see you next week.